This is our Forex blog for January 9th, 2012. And like most days, we want to buy the strongest currencies versus the weak, and we want to sell the weakest ones versus the strong. One of the things to realize about trading any market is markets go up and markets go down. If a market has gone up too much, there's no one left to buy, and therefore it has to pull back before people are willing to buy it again. It's an auction process. And so, most days we look at the real-time momentum, and if it matches the daily and weekly trend, which is underneath it, then we want to trade in that direction. The monthly trend I don't really use much myself other than to decide how many lots to trade. If all the time frames are up in an extreme amount, then I might trade more lots if the monthly trend matches the daily, weekly, and real time. So starting out today, the dollar and the yen both have a daily, weekly, and monthly trend that's up, but the real-time momentum is down. You can see weakness followed by very little strength. So on days like this, you certainly want to wait and look for some signs of strength coming in. But if strength has one bar of strength right here, then followed by very little amounts of then weakness, more weakness than the strength, it's not really a very high odds bet to trade that. Here, when it had a lot of strength followed by very little weakness, because the weekly and monthly trend was up, it's certainly safe, or I should say safer, after 10:30 to be looking for the dollar to go strong again. But when you see weakness followed by very little strength, weakness followed by little strength, weakness followed by less amounts of strength here, this is only for about 20 minutes of strength here, followed by 2.5 hours of intense weakness. The real-time momentum trumps the daily, weekly, monthly trend. You just increase your odds by trading these momentum moves when the weekly and monthly trend line up. And if confronted with two different pairs, extreme weakness in the dollar but the weekly and monthly trend are up, versus extreme weakness in another currency like the euro right here where the weekly and monthly trend is down, your better bet is, if you have two currencies that are both weak, trade the one that goes in the direction of the weekly and monthly trend. We're just trying to increase our winning percentage as high as possible and reduce our risk. If you, let's say, sold the euro here and it had a little bit of strength here, and you bet that it's going to go down again, and it does, but then it shoots back up, it's less likely to shoot far against you. You're likely to have a smaller loss. This currency is likely to go down a little bit, thus allowing you to reduce your stop and therefore have a smaller loss than if you were fighting a longer-term trend that was up. And that's all I'm saying. So today in the New Zealand, all the time frames line up. Extreme strength, daily, weekly, and monthly trend is up. And normally you want to trade this against some of the weakest ones. But the weakest ones were the euro as far as the longer-term trend, but it was having strength today. So you really can't do that. But you can trade it against one that's slightly less weak longer-term, which is the pound. It had some strength followed by weakness, weakness followed by very little strength. It's likely to resume the past momentum if the counter-trend move doesn't have that much intensity, if it's in the direction of the longer-term trend like this. So coming up to 2:30 right here, you can see the exact opposite pattern in the New Zealand. Lots of strength, all the time frames are up, very little weakness for only one 5-minute bar. 2:30, it's likely to resume its strength. So looking at a chart, this is one that we don't look at that much, the pound New Zealand, it's likely to go down after 2:30. And let's look at the chart here. That's exactly what you see. This is what I mean by stacking all the odds in your favor. The trend's down, you have a nice little pullback trade right here. We only have two methods of getting into trades. One, use a currency meter to spot the ones most likely to move in one particular direction. This one was a no-brainer because the pound was weak on all time frames. The New Zealand was the strongest on all time frames. So you're in the currency that's most likely, just because the past means that the pound's one of the weakest and New Zealand's the absolute strongest doesn't always mean that it's going to continue that way. But typically, you're more likely to get a nice trend. And so you get this pullback trade right here, pullback, you draw a trend line underneath the bars going up off the lows. And for me, the minimum pullback I'll consider is 15 pips. And I prefer 25 to 30 pip pullbacks. Primarily if there's a resistance area here. Once a support area gets broken, it tends to become resistance. They're likely to be selling here. If traders are in a position long, and then it goes against them. When it comes back to break even, they're more likely to sell to get out, and it's not likely to go through that area. So those are all things you can do to increase your odds and reduce your risk. But you can see if you sold this when it broke underneath here, somewhere around 59, it went all the way down. It went 111 pips your way, using the currency meter as a guide. Now again, you certainly can, if you're a scalper or intermediate time frame trader, if you like to get 10 to 20 to 25 pip wins and you like to keep your losses 5 to 10 pips, you can use this real-time tool. A lot of weakness followed by very little strength. Trade the dollar on the short side versus the yen because it had less weakness than the dollar did. So coming up to 1 right here, what was the strongest one? Well, the euro was very strong, stronger than the pound, of course. And so you'll be looking for a small trade in the euro dollar to the upside around 1. You don't know if it's going to continue or not because the longer time frame trend is down. So looking at, here's a 6 pips per bar chart. This is underneath the hourly. When it's underneath the hourly, it's more likely to go down. When it's above the hourly, it's more likely to go up. Sometimes currencies find resistance at the hourly, and if they can't resume their downtrend, when it breaks out above here, that's a great place to go long. Somewhere around here when it breaks over the high at 16, out at your stop here at 41, that's over a 20 pip win. You got another little pullback here, small, pretty much break-even trade, another trade here at 54 out with barely 10 pips. And the upper containment bands do a great job of containing price, especially when if you hit the upper containment bands and the weekly and monthly trend are down, this is a phenomenal place to look to get out of your trade. Also, you always want to draw your fibs on previous moves to get an idea of where to get out of trades. Notice the market went up, found resistance at the first fib target, and then the second, and it didn't reverse at that point. That's all right. At least it stalled. You'd be out of your trades. Usually the next wave up is where the market's going to run out of steam, and it did the same thing. 1.382, you're out of your trade. You might look for a counter trend trade, maybe made 5 or 6 pips here. Comes up to the second one when it can't go higher, and you can see the strength fall off a cliff right here. You go short, and you can see because the longer time frame trend is down, you're actually trading with the trend up here at the highs because the longer term trend is down. The short term intermediate intraday trend is up, but the longer term trend is down. So you can take trades, small trades in these and hope that you make 10 to 30 pips trading against the longer term trend. But when it runs out of steam up near a likely reversal area or upper 2.0 white containment bands, do a counter trend trade up here somewhere around 79. And if you got out with a stop here at 58, you made almost 20 pips. It's a wonderful win versus risking 6 to 8 or 9 pips. You made 20. That's good trading math. Here's some of the patterns that you really want to look for. And let's forget the daily, weekly, monthly trend. Real-time strength followed by very little weakness. That momentum to the upside is very likely to continue, as you can see it does. The daily, weekly, monthly trend being in the direction of the trend just adds to your odds. This is probably, in my estimation, this is my opinion only, don't take it for fact, is maybe 60-65% likely to continue this trend. If the daily, weekly, and monthly trend were all up, it might be slightly higher, 5 to 15% higher odds of it going up. Keep in mind, again, that when a currency is above its upper 2.0 band, the odds of the trend continuing are much lower, oftentimes 50-50. That's why I don't like to buy above the upper containment band, nor do I like to sell below the lower containment band. Notice the end of the down move happened at the 2.0 band, and the end of the up move happened also by our 2.0 containment bands. These are made up of the highest volatility over the last 20 days, plotted off of the hourly moving average in the middle. So it's a very key area where trends oftentimes reverse. Now, one of the other things that led to this move up today was our FX trend reversal signal right here. This is on either a 3 or 4 hour bar, and we use multiple time frames in our systems. When a 3 and 4 hour bar has gone up or down too much, in other words, it might be a few days down. Look, you can see, big, huge down day here. Another one, and there's another counter trend signal right here, and it didn't lead to a reversal. And then we had another huge move down where you had another counter trend signal. So this one was extremely oversold. There's no one left to really sell it at the lows, and it needed to pull back. That combined with some real-time momentum coming in after it really gives you, higher odds of buying a currency that is weak over the last week and month, but it had a counter trend move today. Keep that in mind. Now, New Zealand is strong on all time frames, and one of the weakest ones today was the dollar. You certainly, if you're going to trade two currencies against each other, and one of them, it's always best to have one of them that's strong on all time frames, even if the other one is also strong on longer time frames, but extremely weak short term. The New Zealand dollar would have been an excellent one to be looking to buy earlier today. And again, notice the hourly moving average in the middle. Underneath that, it's more likely to go down. When it came up to it and found some selling here and broke out above it, very high probability place to go long. And you can see it went from about 78.10 all the way up to a little bit over 60. This currency doesn't typically have the highest volatility. You might have got into your trade here out at this resistance area, only made about 10 or so pips. Got in again here, you'd be looking at the previous day's high as your resistance area, and it shot through that, and again, notice our outer containment bands are areas where the market typically, unless it has extreme 80 to 100 plus strength, will continue. It tends to stall price there.